Most people think a car loan is just math. You borrow money, you pay it back. You pay a little extra for the privilege. End of story. It isn't. What happens inside a car loan, the actual mechanics, the sequence, the psychology, is one of the clearest windows into how wealth is built or destroyed, quietly, over years, without most people ever noticing. And the reason so few people understand it isn't that it's complicated, it's that they were never shown the right picture. By the end of this, you'll have that picture. And once you see it, you'll never look at a monthly payment the same way again. Here's where most explanations start. The interest rate. 5%, 7%, maybe 9% if your credit score isn't great. And that number feels meaningful. It feels like the whole story. It isn't anywhere close. Think about someone named Marcus, 26 years old, solid job, first real car. He's looking at a $32,000 SUV. The dealer says 60 months, 6.9%. Monthly payment comes to $631. Marcus does the mental math. $631. He makes good money. That works. He signs. What Marcus didn't see, what almost no one sees, is what that loan actually costs. Over 60 months, Marcus pays $37,860. He borrowed $32,000. The difference is $5,860. That's the price of the loan itself, sitting quietly inside a number he never once thought about. Most people look at the monthly payment. They never look at the total. But that still isn't the expensive part. There's a concept in finance called amortization. And it sounds technical, but the idea is simple. When you borrow money and pay it back in equal monthly installments, the lender doesn't split the debt evenly. They front-load the interest. In the early months, most of your payment goes to interest. Almost none goes to the actual balance you owe. Marcus's first payment of $631. About $184 goes toward interest. About $447 goes toward the principal, the actual car debt. By month 30, the split has shifted slightly, but for the entire first half of the loan, Marcus is paying more in interest than in debt reduction. Here's why that matters. If Marcus hits a rough patch at month 24 and needs to sell the car, he'll discover something uncomfortable. He still owes close to $20,000. His car, 2 years old, is now worth maybe $22,000 if he's lucky. Cars depreciate fast, about 15 to 25% in the first year alone. He walks away with maybe $2,000, 2 years of payments, 2 years of $631 a month, and he has almost nothing to show for it. This is what amortization does. It makes the beginning of a loan expensive in ways that aren't visible in the monthly number. Now layer in depreciation. Because a car loan and a car's value aren't moving in the same direction, when you drive a new car off the lot, it loses value immediately. The national average is somewhere between 10 and 20% in the first year. By year 3, it might be worth 50 to 60 cents on the dollar. By year 5, when a typical loan ends, some vehicles are worth 30 to 40% of what was paid. The loan, meanwhile, is shrinking slowly, especially early on, because of amortization. So there's a period, often in the first 2 to 3 years, where what you owe on the car is more than what the car is worth. Lenders call this being underwater or upside down. Marcus might be driving a car worth $26,000 while owing $28,000. He has negative equity. He owns a liability dressed up as an asset. This is where something strange can happen. If that car is totaled in an accident, standard insurance pays the market value, not what you owe. If the market value is $26,000 and you owe $28,000, you receive a check for $26,000 and still owe $2,000 on a car that no longer exists. There's a product called gap insurance that covers this difference. Most people who need it don't have it. Most people who have it bought it from the dealer at a steep markup when it's available far cheaper elsewhere. The details of every single layer of a car transaction tend to work the same way. Let's talk about someone else, a woman named Emily. She's 31. She wants a car around the same price as Marcus, call it $32,000. But Emily has been thinking about this differently. She puts $8,000 down. She takes a 48-month loan instead of 60. Her rate is the same, 6.9%. Her payment is higher, around $584 a month. But the total interest she pays over the life of the loan is about $3,100. Marcus paid nearly $5,900. She also exits the underwater zone faster because her principal drops more quickly. By month 18, she likely has positive equity. She owns more of the car than she owes on it. The difference between Marcus and Emily isn't income, it's structure. The terms of the loan, the down payment, the length, even the interest rate, interact with each other in ways that compound over time. Small changes in any of those variables create large differences in the final outcome. And here's what makes this more than a car story. Marcus is now paying $631 a month. Emily is paying $584. The difference is $47 a month. That's barely anything. But Marcus's loan is 60 months. Emily's is 48. Marcus spends an extra 12 months paying $631 after Emily's car is already paid off. Emily takes that $584 a month that she was paying and does something with it after month 48. She puts it towards something that goes up in value, not down. She's not trying to get rich quickly. She's just redirecting money that used to go toward a depreciating liability. This is the part of wealth people miss. It's not about the car. It's about what the car decision costs in terms of future options. A car is unavoidable for most people. The loan structure isn't. The length isn't. The size of the payment isn't fixed by the price of the vehicle. It's shaped by every single variable you negotiate. And most people negotiate only one: the monthly payment. The monthly payment is the single most effective tool dealers have. Not because they're villains, because it works. People anchor to a number they can afford in the present. They stop calculating anything beyond that. Here's a real mechanic of the showroom. A salesperson isn't primarily selling a car. They're selling a monthly payment. Watch how quickly the conversation moves from price to payment. It isn't an accident. Once a buyer is thinking in terms of monthly payments, the total price becomes invisible. You can stretch a loan from 48 to 72 months, raise the price by $4,000, drop the interest rate by 0.5% to mask it, and the monthly payment barely moves. The total cost increased significantly. The buyer never noticed. 7-year car loans, 84 months, are now common. A decade ago, they were unusual. They exist because they allow people to buy more expensive cars while keeping the monthly payment in a range that feels acceptable. They're also catastrophic for equity. By the time an 84-month loan is halfway done, the car might be 6 years old and worth half of what was originally borrowed. The interest paid over that term can rival a modest vacation. Think about the difference between an asset and a liability. Not in a textbook sense, but in a cash flow sense. An asset puts money into your pocket over time. A liability takes money out. A car, in almost every case, is a liability. It costs money to buy, to fuel, to insure, to maintain, and it declines in value every year it exists. That doesn't make a car bad, it makes it a tool. You need a tool that works. But tools have costs, and those costs should be as low as possible given your actual needs, not as high as your budget can absorb. Most people unconsciously treat car purchases as an expression of identity or success. When income goes up, car payments go up. Not because they need more car, because the limit of what's affordable expands, and the instinct is to fill that space. What that actually does is convert income into a monthly outflow that purchases a rapidly depreciating object. This isn't a moral argument, it's mechanical. The money spent on a car over a decade doesn't go anywhere productive. The money not spent, the difference between what someone could have bought and what they actually needed, doesn't vanish. It exists as optionality. It can become something else. There's a version of this story from the 1990s that's become almost a cliche in personal finance circles, but it holds up. A school teacher and a doctor. The doctor drives a new luxury vehicle, financed over 5 years, traded in every 3 years for a new one. Over a working life, the rolling payments and depreciation are enormous, hundreds of thousands of dollars flowing through cars. The school teacher buys used vehicles with cash, drives them until they stop working, and directs the freed up cash flow into index funds. Decades later, the school teacher has a larger net worth. The anecdote is simplified. Real life is messier, but the underlying pattern is real and well documented. Wealth in most households isn't primarily built through income. It's built through the gap between income and recurring obligations. And car debt is one of the largest recurring obligations most households carry voluntarily. Now, a counter-argument worth taking seriously. Some car loans at very low interest rates genuinely are not the expensive decision people describe. If someone can get a 0% or 1% financing deal on a car, and they would otherwise invest that down payment in something returning 6 or 7%, the math can favor the loan. There are real scenarios where financing a car is strategically correct. The problem is that this calculation isn't what most people are doing. Most people aren't modeling out net present value and investment return differentials. Most people are financing a car because they can afford the monthly payment, and they want the car. And in that scenario, the actual scenario most buyers are in, the loan structure, the term, the interest rate, and the vehicle's rate of depreciation all interact to cost them far more than they calculated, in far more places than they checked. The logical version of a car decision looks like this. Define your actual transportation need first. Then find the cheapest reliable vehicle that meets it. Then, if financing is necessary, minimize the term, maximize the down payment, and get the lowest possible rate through your own bank or credit union before walking into a dealership. Never negotiate payment, negotiate price. Then choose your own financing. That's not revolutionary advice, but almost nobody does it, because almost nobody frames the decision that way at the point of buying. The real insight here isn't about cars. It's about the relationship between big recurring decisions and long-term financial outcomes. Car debt is one of the most visible examples because the mechanics are trackable. You can see the amortization schedule, the depreciation curve, the equity position. But the same pattern plays out in every large recurring financial obligation someone takes on without fully understanding the structure. Understanding a car loan completely, not just the monthly payment, but the amortization, the depreciation, the equity position, the opportunity cost of every dollar going toward interest, is one of the clearest exercises in financial literacy available. If you can read a car loan clearly, you can read any debt clearly. You can ask the right questions. You can spot where the cost is hidden. You can make decisions based on the total picture, rather than the monthly number in front of you. Marcus and Emily bought the same car. Marcus will spend years underwater. Emily built equity in months. Neither of them did anything dramatic. The difference was in the structure of what they signed. There's a loan comparison worksheet linked in the description. It lets you input the price, down payment, term, and rate of any vehicle and see the full picture. Total interest paid, month-by-month equity position, the point at which you cross from underwater to above water, and a side-by-side comparison of 2 loan scenarios. It's the thing I wish existed every time I've watched someone sign a car deal in 30 minutes without understanding what they'd actually agreed to. If you find value in breaking down financial decisions the way we did here, slowly, with real numbers, without making it feel more complicated than it is, there's more of this on the channel. The subscribe button is there if you want to keep going.